Welcome to The Explainer. Today, we're going to break down a concept that, honestly, keeps economists up at night and has a direct impact on your wallet. We're talking about the wage price spiral.
Okay, so after the pandemic, you've probably noticed that prices for, well, pretty much everything have gone up, right? And that sparked a big, kind of unsettling question that economists are asking themselves.
So, is this all just a temporary inflation hiccup, or are we actually caught in something more dangerous, like a feedback loop, where rising prices and rising wages just keep pushing each other higher and higher? Now, this isn't the first time we've faced this kind of threat. You just have to look back to the 1970s. That decade is a huge cautionary tale for policymakers today. It's a classic example of what happens when this kind of spiral really gets going.
So, that's the big question, right? How can we tell if we're really in a spiral? Well, economists don't just, guess. They've got some pretty powerful tools to try and figure out what's coming next. Okay, let's get into it. We're going to look at two really different ways they tackle this. First, a kind of virtual lab where they can run crash tests on the economy, and second, a real-world index that's basically a riskometer for what's happening right now. All right, first, let's step into this virtual lab. It's a simulation called the Mark Zero model. And honestly, the best way to think about it is like SimCity, but for economists. It lets them see how the whole system reacts when things get really crazy. Now, this isn't your typical economic model. It's what's called an agent-based model. So instead of looking from the top down, it simulates a complex world filled with thousands of individual households and businesses all making their own decisions. And you get to see how those small choices can lead to big and sometimes totally surprising outcomes for the whole economy.
And this quote really nails why it's so cool. It's a telescope for the mind. It's all about helping us see potential futures. The stuff that might be just over the horizon. So what did they do? Researchers used this model to basically hit the virtual economy with the same three massive shocks that we all lived through during the pandemic. First, a huge drop in spending, then the supply chain chaos, and finally, that absolutely wild swing in energy prices.
And the first big takeaway from the simulation was pretty clear. Doing nothing was not an option. Without policies like helicopter money, stimulus, the model showed the economy either going into a full-blown crisis or just a super sluggish, painful recovery.
But here's the catch, and it's a big one. The simulation also showed a real danger. That same stimulus that was needed to prevent a crisis, it could also be the very thing that lights the fuse on that wage price spiral everyone was so afraid of. Talk about a tough spot for policymakers.
Okay, so that's the virtual world. Let's move from the simulation to reality. What does the real-world data tell us about all this?
All right, check this out. This chart is basically an economic fever chart. That red line is the wage price index, and the blue area is what you could call the safe zone. As long as the red line is chilling inside that blue area, things are more or less normal. But when it breaks out, that's when the alarm bells start ringing.
So what happens when you look at the actual data? Well, the model points to two major times when wages and prices were both growing really fast at the same time. The first episode? Yep, the 1970s, right after the oil shocks. And the second? You guessed it, the 2020s, right after the pandemic and the war in Ukraine. So there you have it. The simulation warned that this could happen, and the real-world data basically confirmed it. We recently entered a high-risk zone for a spiral, for the first time in decades. A situation we haven't really been in for 50 years. Okay, so we started with a big question, and we've dived into some of the cool tools economists use to figure this stuff out. But now let's zoom back out. Why does any of this really matter to you?
Well, the bottom line is, the evidence from both the simulation and that real-world index showed that we had, in fact, entered a high-risk zone. The threat was absolutely real. And that's exactly why you saw central banks around the world start to act so decisively, raising interest rates like they did. And that's the tightrope they have to walk. They need to cool the economy down to stop the spiral, but they can't go so far that they cause a deep recession. And their decisions? They directly impact the interest rates on your mortgage and loans, whether it's easy or hard to find a job, and ultimately the cost of living for you and your family.
And that leaves us with the final, really big thought. In a world that seems to be full of constant shocks, how do we balance giving support today with making sure things are stable tomorrow? It's a huge question, and getting it right is one of the toughest challenges we face.